Hi, I'm Chris Grisanti, Chief Market Strategist at MAI Capital Management, and I'm very excited today to present a new format for communicating to our clients about how we're thinking about the current markets, both the year just ended and, more importantly, the year ahead. We know you probably have access to a lot of market commentary, so we wanted to try something a little different. We're calling this format Talking Shop. And instead of me just droning on about the markets, we thought a conversation between two people who live and breathe markets every day might be more interesting. For that, I'm joined today by my colleague, Kurt Nye, our new Chief Investment Officer. Kurt, welcome.
Thank you, Chris.
I've been a market guy my whole career and have managed a value-oriented equity portfolio for more than 25 years. Kurt has been part of MEI's investment team since 2011 with an emphasis on private markets. I've always thought that immersing yourself in private investments is a great way to understand all markets, since you don't have the benefit of a publicly set market price every night like I do. So Kurt takes that background and now applies it across all asset classes. Kurt, let's talk some shop. The U.S. stock market has, as represented by the S&P 500, has just ended a second year in a row up more than 25%. It hasn't done that since the internet bubble years of the 1990s. I remember that point in time quite well. I was managing an equity portfolio back then, and my value portfolio was getting trounced by my kind of growth tech-heavy competitors. Of course, that all unraveled in 2000 and value prevailed, but this market is starting to feel like that. The current market is the second most expensive in the last 100 years on a price to earnings basis. And it's even the most expensive on a price to sales or price to book metrics. So I have to say, that's making me nervous. Why doesn't that make you as nervous as it makes me?
I think it does make me nervous. I think it should be a bit of a caution flag, but we should recall that even in the mid-90s, if we go back to 1996, Alan Greenspan had this really famous speech where he coined the phrase rational exuberance. And from that point in time, where he was concerned about valuations in late 1996 through the end of the 1990s, the market compounded at 26% per annum.
Good point. So if we bail now, we'd miss 26% a year for the next 3 years. Now, of course, that the history never repeats itself exactly. But you're exactly right. I remember those times very well. And his feeling in 1996 is the same as mine now. Things are looking frothy. But again, they stayed frothy for quite a while.
Yeah, valuation can be not a great timing indicator.
A terrible timing indicator. Absolutely. Right. Absolutely.
And I think it's important when we think about the stock market, as it's more than just one collective. We have this Magnificent Seven construct, which you've talked about several times. But was there anything in 2024 that really kind of changed underneath the market surface?
Sure. It's a great question, Gert. So if you look at the numbers, 2024, to quote Yogi Berra, it's deja vu all over again. It's just like 2023. But if you dig a little bit deeper, it was really the tale of two different periods. So the first 6 months was exactly what you're talking about. The Mag 7 led the way, growth beat value, large beat small, the US beat Europe and emerging markets. But really and we can pinpoint the date as July 10th. Since July 10th to the end of 2024, value actually beat growth, and small cap almost doubled the return of the S&P 500. So there's a shift going on beneath the market. Now, whether that will continue in 2025 is anyone's guess, but I think it denotes a broadening, a healthy trend in the market that may save us from an internet-like, collapse later on.
Very good. And I wonder if we'll see that same broadening out trend that you were just referring to, not only in the domestic equity market, but more globally. If you look at the performance of the US market versus international stocks since the GFC,
the global financial crisis, right?
The US stocks have dominated international stocks in terms of performance. And that's reflected in some very large market indices. So if you look at a global market index, and we like to use the MSCI All Country World Index or the ACWI, the US share of that has grown from mid 40% upwards of about 2/3 right now. that's an amazing portion of the index being concentrated in one country. And that one country, the United States, represents about 15% of global GDP.
Wow. So that's a big disproportion. I'm old enough to remember in the late 80s, the Japanese markets expanding just like that. And a whole bunch of the top 10 largest companies in the world were Japanese back then, and now not a single one. So these things do go in trends. The problem, as we mentioned before, is you don't know the time, the day nor the hour when these things are going to change.
Absolutely. And so it's not to suggest that you should move away from the United States allocation, but having some amount of international allocation can make sense. And certainly it's true that U.S. companies have some portion of their revenues coming from abroad.
Well, and I would say the same thing for the U.S. stock market, which is my area of focus, which is that this is not a call to panic and go to cash at all. I did manage money in the late 90s, and the answer was not to go to cash. It was to pick and choose among those companies, leave the ones aside that are getting really expensive, but the dirty little secret is the creation of an expensive market means capital is flowing to those stocks, but it's leaving others behind. And that happened in the late 90s when financials got very cheap. Now it's happening with other sectors in our current market. For example, healthcare has underperformed the S&P now for 2 years in a row. And the large pharmaceutical companies are at their cheapest compared to the S&P in 25 years. So
it's an impressive statistic.
It's exciting. And they have safe dividends. They don't grow nearly as fast as the Mag 7. But when things start to get more difficult, it might be nice to have some assets in these more attractive sectors.
That makes sense. And when you talked about capital being allocated to these names, have we reached the point where it's actually a misallocation of capital, or is it deserved?
Well, that's a really interesting question. And we spend a lot of research on the Mag 7 in particular. So nobody can argue that the Mag 7 have high price earnings ratios. The question is, do they deserve them because their earnings are growing so fast? And so when you dig under the surface, the earnings growth right now would seem to support the valuations. The problem is, just like it was in the late 90s when people said the same exact thing, those earnings can change. So I think a prudent investor would be very careful on taking earnings projections for any of the Mag 7 out 2, 3, 4, 5 years as gospel. Instead, I think what you should do is be prudent, recognize that these price earnings ratios reflect a very high growth rate, and adjust your portfolio accordingly.
That makes sense. And when we were kind of preparing for this, just going back and researching the dot-com bubble, as I was not managing a portfolio during it, you saw nearly $1 trillion of capital being raised by Wall Street for the communications industry at the peak of a bubble. Right? Today, we're hearing about $1 trillion of capital being raised to support the growth in AI or artificial intelligence with these massive, massive data centers. Is it different this time?
Well, I always like Mark Twain's quote that history doesn't repeat itself, but it rhymes. And clearly it's different this time. It's different in a lot of different ways. For example, we haven't seen the IPO craze that you saw at the peak of the internet bubble with lots of companies, not only with no profits, but with hardly any revenues coming public because they had an idea and a .com in their name. That was back then. Here, we're not seeing that, at least not yet. And I think it's very important that investors distinguish between ideas that will change the world. The internet was certainly one. AI will certainly be one, and ideas that can make you money in your portfolio. And they're two very different things. For example, Amazon in the late 90s was a darling stock, and it was one of those caught up in the internet bubble. Of course, it survived to great success. But in between, Amazon dropped by over 90%, even though it was a great, great company. So my point here isn't to buy or sell any particular company, but is to not just think, oh, they're AI, that's going to be a successful investment. And just like back in the 90s, oh, that's internet, that's going to be successful. It depends on what you pay for it, and it depends on that particular company versus its competitors in the same space.
That's a great point. I mean, I remember in the search engine space, right, where you had names like Alta Vista and Ask
Good.
Jeeves and Yahoo was the dominant player.
And you say you didn't manage money then. That is exactly right. Right.
And you had these search engines of search engines, right? And
Right.
that was the model until, the latecomer, Google, came in and really dominated it. So turning maybe back to fixed income, last year was an interesting year for the fixed income markets. And then we finally saw the yield curve, which in a normal market, the yield curve is upward sloping. What we had been in a long time is this market where the yield curve had higher short-term rates than long-term rates. With the benefit of the Federal Reserve rate hike cuts and the increase in long-term interest rates, we're finally back to a normal yield curve.
Hallelujah. Right.
Yes. Of course, previous uninversions of the yield curve have been pretending economic stress, maybe, but there's an alternative. If we go back to the mid-2010s, there was this phrase, TINA, where people suggested that there is no alternative to investing in the stock market because you had near zero yields. If you were investing in bonds, you were hoping for a diversification benefit. Now, in treasuries, you can achieve almost 5% on a long-term treasury. In corporates, you don't even have to go out nearly as long. How should we think about that?
Sure. So I'm thinking instead of TINA, we now have TILA. There's lots of alternatives. So stocks had better up their game, I think, because they used to be the only game in town. Now they have to compete, exactly what you're saying, against a 5% yield or more in the corporate bond markets, for example. So that tailwind of being the only alternative is gone. The other headwind now is higher rates. I'm also concerned, Kurt. So we've got full employment and we've got corporate earnings that are supposed to grow 15% this year, if estimates are right. That's a terrific economy. And again, I hate to keep bringing up the 1990s, but we haven't seen that kind of economy and stock market since then. So I'm a little afraid that rates are going even higher, long rates. And so your curve not only is steep now, but it will get steeper. So I think that's going to be a headwind as 2025 goes along. Bond investors will eventually be happy because they'll be getting even higher yields, at least on the long end. And but I think that's going to be a tougher headwind for the stock market as we go on, especially as the 10-year approaches 5%. Well, the one thing we haven't talked about, and it's frankly been refreshing, is politics, and especially because that's all we talked about last year. So as I look across the public markets, I see a somewhat euphoric mood about the new administration. And I don't think that's necessarily, I think it's partly pro-Trump, pro-business expectations. But I also think every time a new administration comes in, the market gets kind of excited about it. The first year of the presidential cycle has historically been the best one for the stock markets of the four. So I think we're seeing an anticipation of that. But do you think that gets a little harder once they take office? What do you think?
I do. It's that old talk about animal spirits and people buying into the hope. On the other hand, I actually think that where we could see significant change, and we're not talking about going out and purchasing Greenland at this point in time.
One hopes. Yeah, right.
Yeah. But is in kind of loosening the regulations around mergers and acquisitions. So we've been in this regulatory regime where it's been very hard for these companies to pursue strategic transactions. You have very strong public company balance sheets. You have elevated stock price. And so you have this wonderful currency and equity for these CEOs to go out and make acquisitions. And you combine that with a private market backdrop where exits have been fewer and far between.
Right. Because of the phenomenon you're talking about, which is the blockage of M&A in the public markets.
That's right. So you could have the kindling there for kind of a resurgence in deal activity.
Yes. And I think regardless of your political leanings, it's tough to argue that the government is the best allocator of capital. So if you release the shackles and allow those folks whose job it is and whose livelihood depends on the correct allocation of capital to do that, I think you could easily argue you're going to get a more efficient marketplace and probably a more profitable one.
Absolutely.
Yeah. Well, you're all probably getting the feeling that Kurt and I can go on like this for a long time, probably too long. So why don't we end it here? I think that It's exciting to start a new year. It always brings optimism. Slates get wiped clean. And in our research department, pencils get sharpened. I hope this gives you the sense of the kind of research and thinking we're doing all the time at MAI. Opportunities for investments can be found in lots of different kind of markets, including expensive ones. And if I can speak for Kurt, I think both of us enjoy trying to solve the market puzzles that change literally every day. We both want to thank you for your support, and we wish you a very happy new year. Thanks for joining us.